Corporate finance practice problem using Excel. Cost of preferred stock percent. Get ready, it's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we are in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. We have the information on the left-hand side. We're going to populate that into the blue area on the right-hand side. Remember, we're talking about financing options to finance the operations of the corporation. And there's two main categories, one being the debt financing, two being the equity financing. When we're thinking about the debt financing, which we looked at in the past, this time we're looking at the equity financing, starting with the preferred stock, and then we'll move on to the common stock. The preferred stock on the equity side of things typically being a little bit easier due to the restrictive nature of the preferred stock. It's also a little bit easier in some cases than the debt financing due to the fact that when we think about debt financing, we have to deal, of course, with the interest, which is going to be the cost that will be there for the debt financing. With regards to the preferred stock, the cost that we're talking about would be the dividends typically that would be paying out, our major cost. And on the debt financing, the interest that we have to pay actually has a tax consequence, as we saw, in that you could have a tax benefit of the interest that is being paid. So you got to take that into consideration. We don't have that same kind of consideration here dealing on the equity side of things. Therefore, it can actually be a little bit more straightforward of a calculation. So we have the preferred stock. We're going to say that we can sell the preferred stock for $150. The estimated flotation costs, the cost of us basically issuing the preferred stock, basically the administration cost of us issuing the stock, would be $4. And then we're going to have the major cost to us, which means the dividends, we the company paying out the dividends to the preferred stockholders, which are going to be $9 on an annual basis. So we're kind of calculating this basically on an annual kind of basis here. So we're going to say, all right, what's the cost of preferred stock on percent? We can take then the annual dividends. Let's start with the annual dividends. That's basically the major cost that we have, which is going to be the $9. So we're saying it's $9. And then I'm going to say the net sales price, let's call this, because I'm going to subtract out what we're going to get, the $150 minus the cost of us getting it, the $4. So let's take the $150 sales price. I'll call it sales price of preferred stock. And that's going to be then the $150 minus the estimated flotation cost, which we're going to say is $4, which will give us the net sales price. And I'll pull that to the outside here, which is the $150 minus the 4. So basically after those flotation costs, we're going to get the $146. I'm going to go to the Home tab then, Font Group and Underline. Going to select these items and then indent them, go into the Alignment Group and indent, then the Net Sales, Alignment Group, indent again. That's going to give us then the cost of preferred stock percent that we'll have. And that's going to be equal to the cost, the dividends that we're going to be paying out on an annual basis, we're assuming here, divided by the 146 cost. And that's going to give us our percent number group, percentifying it. We can add then a couple decimals. We're looking about 6.16%. Going to go ahead and underline here, Home tab font and underline. So note again, they're a little bit more simplified because of course we're not dealing with the interest. The cost is going to be the dividends that we have up top, and because this is going to be equity coming out of the equity, we don't have something resulting on the income statement with this transaction, and therefore it shouldn't have an impact on the taxes as well. So we don't have that kind of tax impact. We're comparing the annual dividends that we have, which should be somewhat standardized for the preferred stock, to then the net price, meaning the 150 minus the cost of us issuing, 150 we received minus the cost of us issuing, giving us that 6.16% in this case.